Good morning, everyone, or good afternoon, wherever in the world you are. Thank you to everyone joining the session today. This session focuses on the relationship between financiers and fintech platforms and the types of financing solutions that we're seeing in the market today. Before we get going, I'm delighted to introduce my fellow panelists today. We have Daniel. Daniel is director in the specialty finance team at Fortress, which has a mandate to provide asset-backed financing to fintech platforms and other non-bank lenders, including senior, mezzanine, unitranche, and forward flow financing across various asset classes. Next, we have Huy. Huy is a CFO and head of private debt at Teylor and leading Teylor's investment team, Teylor Capital. In his dual role, he is mainly responsible for the strategic planning and development, deal structuring, and fundraising for the platform. Huy has very recently closed one of the first German SME securitization structures of an alternative lender in June 2023. Next, we have Oliver. Oliver is a partner in the Clifford finance team in Frankfurt. Oliver advises on German and international structured finance transactions, portfolio trades, and alternative investments. His experience includes the securitization of trades, consumer, leasing, and loan receivables, and the structuring of ABCP conduit programs. And myself, I'm Soojean, and I'm a senior associate in the Structured Asset-Backed and Real Estate Finance Group in London, and I'll be moderating the panel today. My experience includes advising on a range of forward flow financings and portfolio acquisitions, and related financings and securitization exit takeouts, advising players across the market in the fintech, unsecured consumer loan, credit card, and RMBS space. So without further ado, to kick us off, Huy, from your perspective and in the current economic environment, and in particular in the new age of higher interest rates, what from your perspective are the types of financings that you're seeing fintechs and potential investors lean towards as well? Could you give us a bit of color on the type of options that you're seeing platforms use and think about maybe some of the challenges that platforms might come across as well?
Yeah, thank you for the question, and very happy to take this one. I think in contrast to the period prior to COVID and also the resulting inflation, the new environment is marked by a balanced credit appetite and clear focus on the higher return expectations. This is mainly driven by the potential for debt instruments to generate low teens for secured capital, or even equity-like returns for riskier assets with some kind of downside protection. And for that reason, and looking more into the direct lending market, I think direct lending in general has an important role to play, where traditional banks may still be risk averse. In general, looking into the European market, that there's a very strong trend where we saw market share of debt funds significantly below 5% 10 years ago, and nowadays looking into debt funds in some of the European countries, the funds have market shares over 70%, which is quite significant. And as compared to what we see on the traditional banking market, also a significant development. In general, looking into the conditions of the credit markets this year, certainly slightly improved, although not at the speed which many market participants would hope for. In general, also looking into last year, I think there was cautiously an optimistic environment, and also looking into the underwriting standards, much of the topics went through. So looking on our side and considering also our investment mandate, we continue to see a good risk-adjusted returns and significant activity on the origination side as well. So in general, for debt investors, I believe the economic environment requires certainly a sector-specific approach, whereby borrowers' ability to repay the financing is mainly driven on the free cash flow side and also on the net leverage levels in general. I hope this answers your question so far.
Soojean, I think you're still on mute.
Thanks. Sorry, apologies all. But yeah, I was just saying thanks very much for that insight, Huy. I guess just to touch on some of the things that you mentioned as well, and Daniel, to talk about some of the things that we're seeing in the market as well. One of the things that we've been seeing is, of course, the usage of asset-backed financing techniques in the market, which, of course, have been very widely used for a very long period of time, but is increasingly a focus in the market. From your perspective, Daniel, can you give us a bit of insight as to why asset-backed financings are such an attractive structure for investors, and what, in your view, are the benefits for investors and platforms?
Absolutely, and maybe let me start from the originator's perspective, because that's really the driver of these transactions to start with. And we wouldn't really be investing in these types of transactions if it didn't make sense for the originators to start with. And I do think this type of structure does make a lot of sense for every originator of financial receivables, but in particular for early stage ones. A key benefit here is that the quality of the asset books of the originators is typically, in most situations we see, actually higher than the creditworthiness of the company itself. And that may be due to a number of reasons. Just inherently, some originators are highly levered or thinly capitalized or loss-making still at the bottom line, or a combination of these things. And just this type of credit profile doesn't really give originators access to the broader capital markets, or to cheap holdco corporate debt that they may be getting later on in their journey. And the fact that they are originating granular, higher quality assets actually allows them to leverage of these and get access to institutional capital at the early stages of their journey. And these portfolios of financial receivables, I think, are much easier to underwrite and much more predictable in terms of performance than the credit of a very early stage platform. And that's really one of the key benefits from an originator's perspective. The other one I would say is that these structures tend to be quite flexible, just because historically they have been, and it's quite easy for the two parties, the lender and the borrower, to negotiate something that works for both of them. And these structures do have a lot in common between them, but at the end of the day, there are quite a few bespoke features that are driven by the needs of the originator, the needs of the investor as well, and just the nature of the underlying assets. And then flipping to the investor's perspective and looking through our lens where I sit. Again, a number of benefits. I would say the key one is that the assets are typically actually segregated, legally separated from the originator. And if something were to happen to the originator and they were to go under or end up in some sort of distress, what typically happens in these structures is that the assets actually sit in a separate vehicle, a special purpose vehicle specifically created for the purposes of the transaction. So even if the originator is no longer around, the investor can bring in another party, so-called backup servicer, to actually service these assets and generate as much cash as possible from them, or otherwise liquidate the assets. Again, I would come back to the point of flexibility as well, just because different investors have different sort of risk appetite and different sorts of preferences and taboos in terms of what they want to invest or what they can't invest in. So choosing a portfolio perimeter for an existing portfolio, or devising a set of eligibility criteria for future originations is actually quite a helpful tool, and also it could help drive returns up or down depending on what the needs are of the investor. So I think quite a few benefits for both, but it all boils down to, I think, the flexibility and really that bankruptcy remoteness.
Great. Thanks very much for that insight, Daniel. I suppose, Oliver, we've been talking quite a lot about asset-backed financing and securitizations. Would you be able to add a bit of background as to what legally that means and how that differs from a traditional corporate debt funding line?
Of course. And Yeah, Daniel has done much of the job already, explaining exactly what we try to achieve. So if you compare securitization to a general corporate lending, then in a general corporate lending scenario, the borrower is the corporate as such, and then needless to say, unless there's any collateral or security provided, the credit perspective is on the underlying corporate, so on its financial strength and the business model and so on and so on. In securitization, we are trying to do something different. We are trying to do asset-based lending. So we take the assets, and Daniel has made a very good point here that actually, if you look at the underlying assets, fintech is originating, then the credit risk inhering in these underlying assets, which are, by the way, most of the times loans and receivables, to make it a bit more transparent, probably have a better credit quality than the fintech or the corporate as such. Yeah, and this shift of the perspective of credit quality is what we try to achieve with the securitization. And the underlying reason many times is that actually the trading history of the fintech is probably rather short. You don't have financial statements for the last 5 years because you probably just exist for 2 or 3 years. The credit history is a bit short, so you are probably not investment grade bankable, and you need to find other ways of getting that financing. And cut a long story short, what we are then doing is we take the fintech has the loans or other forms of receivables, we transfer them to an SPV in a way which we call insolvency remote, so that even if the fintech isn't doing that great, we're not affected by that, and the assets sit safely in the SPV, and then the institutional investors like Daniel can lend against these assets which are sitting in the securitization company. There's also one focal point, sort of an additional attractiveness, is a securitization company will not only issue one form of debt. Yeah, it can issue 2 or 3 different classes depending on the financial model, and that enables the attraction of different investors into different sort of tranches and risk profiles based on the same underlying portfolio. So, Jean, does this make sense to you?
It certainly does to me. I hope that was helpful for the audience as well. I mean, Daniel, we've already touched upon the importance of the assets for these types of financings. Obviously, you and Oliver have touched on the fact that these assets are segregated for the purpose of the financing. When you look at structuring these types of asset-backed financing, and for your perspective as a lender or an investor in these types of facilities, what are the key aspects that you look at when you're looking at the assets, and what do you look at indeed for the wider business as well when you're looking at these types of facilities?
Yeah, well, it says it on the tin a little bit. These are asset-backed facilities, asset-backed structures. So at the end of the day, the most important thing from our perspective is to understand and underwrite these assets. But there are, as you mentioned, Soojean, other aspects to this as well. On the asset side, I would say there are 2 key metrics for us that we look at, and the first one is always the performance of these assets. And as Oliver mentioned, you may not have a lot of performance data as an originator. You may only have a year or 2. Of course, there are more established platforms out there with much more data, but from our perspective, understanding how these assets are underwritten, how they're serviced on an ongoing basis, and also what the broader market looks like, what the borrowers look like, how these assets are originated in the first place, and how they even, how the originator got access to these borrowers. These are all important aspects, and not all of them are quantitative. Some of them are, purely qualitative, and based on experience, we get a sense of, what's a better origination channel than others, what really is the right or wrong way to underwrite assets, and how that would feed into the performance of these underlying receivables. I would say we also look at peer and market data, and if data is available through the cycle for a certain originator or a certain asset class, then that's certainly something we would look at as well in order to, stress test what we think performance will look like. So this is a very important aspect, and ultimately what we think about is, okay, if asset performance deteriorates by a factor of X, does that affect our position, and could we potentially suffer a loss? So that's why performance is so important. The other thing on the asset side I would mention is the volumes of origination, because there's always a thin balance between originating a lot of assets, but originating quality assets as well. So someone could go out there and originate, tens and tens of millions of assets in a few months, but that would probably, result in a slight deterioration of the credit quality. While if you want to have the perfect book without any defaults or any losses, you're probably going to be originating, a few 100,000 a month. So there's always that fine balance as well, and that's something we look at as well. And putting the assets aside, the other things we look at are really the whole value proposition, the management team, their strategy. Is that the right team? Do they have the right people in place to look at data, to look at underwriting, to look at servicing, to look at the financial strategy of the platform? And also I mentioned the platform and the financial standing, and we did say these structures are bankruptcy remote usually, but we do want the originator to be around, because they are usually the entity that is best placed to service these assets on an ongoing basis. So for us, it's also quite important that the financial standing of the originator / servicer is a good enough one for them to continue being around. So yeah, quite a few factors. I would summarize it as focus on the assets, but there are very important ancillary factors that we look at as well.
Thanks, Daniel. Huy, on a similar front, from your perspective as well, are there any key metrics that you look at when you're looking at these types of facilities? And how do you ensure, from your perspective, that you have sufficient comfort both on the assets and on the management team as well, as Daniel has flagged?
Yeah, so for us, as one of the leading players on the market, we are heavily focused on asset quality. So our approach to non-bank origination does not entail compromising on robust underwriting and quality of credit. Ultimately, a borrower that received the financing from Teylor are all generating significant cash flows and have acceptable KPIs, debt to equity, debt coverage ratios, net leverage ratios, etc., which are quite important to us. And in addition to that, we require borrowers to have sufficient assets to cover a reasonable security package. This approach ultimately, on the other side, requires us to have a high quality origination approach, and also reasonable projections on the origination side. As Daniel mentioned, origination volume is certainly one of the key triggers to have a successful vehicle up and running. And from our side, we do see technology as an important factor to minimize inefficiencies for the investment team to be able to understand the quality of the underlying assets. So once a borrower delivers a full information package to us, in general, we will be able to fund within a few days, which is one of the key triggers to be able to have a sufficient platform up and running. And in addition to this, there are specific industries which we like. Looking into our investment mandate, we are strongly focused on the healthcare side, on the pharma side. We like tech assets, consumers, retail, industrials. So in general, very broad. We are looking into that also from a let's say a sector coverage perspective, where our team spends a lot of time to look into different sectors and how they are moving, particularly in the SME environment, and considering the current market environment. It's one of the key factors to be able to identify the right assets for our portfolio.
Great. Sounds like there's a lot of focus there on origination and servicing standards in particular for both of you, and that's really interesting. Here, Daniel, we've obviously talked quite a lot at the moment about the assets that back these facilities, but maybe looking at the other side of the transaction being the sort of liability side and how you structure that aspect of the transaction. Can you maybe give us some thoughts on how you structure the overall liability structure? What do you look at in terms of both the assets and on the liability side when you structure these transactions? And what are the key areas of focus for you when you're looking at investing or lending in these types of platforms? Maybe Huy, I can go to you first, and Daniel, you can add your thoughts as well.
Yeah, so happy to start on my side to reflect the platform aspects on this point, and then you please feel free to chip in here. So from my perspective, it's critical to ensure that the liability structure matches the underlying risk. I think this is the first point and the key point. And practically speaking, this means that our investors always have the opportunity to gain full visibility on our underwriting methodology and also existing portfolio to get a sufficient level of comfort and also the ability to reflect an origination plan which fits into, let's say, the expected asset quality. And as a general result for us as a platform, it is important for us to manage our funding cost in an acceptable way, and also allowing our equity investors from platform level, but also at the level of the ABS vehicle to generate sufficient and acceptable returns on their single investments. And with the asset performance at the very heart of our business, we highly focus not only on the asset quality in general, but also on managing distressed situations actively in order to achieve the best outcomes for our investors, for all the lenders, but ultimately also for the borrowers to have a basis to grow.
Yeah,
Daniel, do you have any further thoughts?
Yeah, absolutely. I completely agree with what Huy led with there. In particular, that the liability side is ultimately driven by what the asset side looks like, and there are some, I would say, typical protections that we would get in transactions of this type, but ultimately, yeah, we get we structure the liability side bespokely on the basis of what the assets look like and what the risks are that arise from the nature of these assets. And I would say, I mentioned already, devising a set of, eligibility criteria or devising a portfolio perimeter for an existing pool of assets. That's a very, very easy way to control what kind of assets you will be funding, and more importantly, what kind of assets you want to be funding. If you want to eliminate some type of, riskier asset or something related to an industry that we can't fund for whatever reason. I would say other types of typical protections on the liability side from an investor's perspective are putting some sort of concentration limits in place, again, for similar reasons, just to make sure that the pool that you want to be funding is within some boundaries, and you want to give the borrower flexibility, of course, to originate different types of receivables, and they don't always know what the pool will look like in 6, 12, 18 months, but you want to have these boundaries. And I would say some sort of performance triggers related to the assets as well, right? Loss rates, these could be broken down into default rates and recovery rates. These are typical protections that we have, but how they're structured and what the thresholds are that we would set very much depends on, first of all, what the metrics are of the overall structure, and secondly, how the assets look like in the first place, and what the nature is of these underlying receivables.
Great. Thanks very much, both. I think, we've obviously talked about the liability side here. And, Daniel, who you've mentioned quite a few features that you might look to include in these facilities. When we think practically and how these are sort of managed with fintech platforms on an ongoing basis, could you maybe give us a bit of color or a bit of a flavor of how you would typically look to monitor these and what you think fintech platforms could helpfully be doing or thinking about when they think about their systems and how they can best sort of prepare themselves for a facility of this type? Maybe Daniel, you could add your thoughts first, and I can come to you after.
Yeah, absolutely. And some of the originators that we work with, I mean, for them it's a first type of institutional capital that they're getting, and they may not be fully up to speed with the reporting requirements of a facility of this type, but that's why we're here for them, and we try to look at this whole relationship as a partnership more so than a lender-borrower relationship. And yeah, ultimately, if you look at the documentation, yes, we will be the lender and the platform will be the borrower, but it's a joint exercise at the end of the day with alignment of interest. We want the platform to do well and originate high quality assets with good volumes, and they want the same. So ultimately, yeah, we would make sure we spend a lot of time with management and with all sort of vertical teams to make sure that the reporting capabilities are there, the systems are there. We will allow them to leverage our knowledge from what we've seen in the market, and if we think, okay, you may get a massive improvement of your underwriting and performance by just making that simple tweak. Of course, we will tell them that it's not a test that they have to pass. It is a relationship, and it's one that we build on constantly during the life of the transaction, and it's a very, I would say, dynamic and complex structure that we usually have with these types of transactions. So it is very, very important that we look at it through a partnership lens, and there's a constant, continuous constructive dialogue, and that's what we always strive for in these type of situations.
Huy, is there anything that you'd like to add there? I mean, is there anything on the system side, perhaps, that you can helpfully maybe suggest for a lot of our fintech platforms, hopefully on this session today, that they can maybe think about or should consider when looking at facilities of this type?
Yeah, I think that the answer from our side is very simple. It is ultimately technology. We believe that the constant monitoring and the portfolio management is ultimately key to ensure to have a performing vehicle, and ultimately on our side as an originator and also as a tech platform, we do leverage our tech systems to be able to work in an efficient basis, and also to manage the wider pool and the significant number of assets in an efficient way. So ultimately, on our side, we actually developed an in-house tech solution to be able to work on a modular basis, which ranges from the onboarding of a client, pre-screening, to deal execution, and ultimately also to the underlying single documentation of the assets going to the closing of the transaction. So it's quite a broad tech platform which we use, and we do believe that it is a key for an alternative lender to be able to operate in an efficient way.
Great, thank you very much, both. And Oliver, maybe turning to the legal aspects, we've talked quite a lot about the economic factors and what investors and platforms might want to reflect in the legal documentation. Would you be able to give us some practical kind of maybe background as to how you think platforms and investors could seek to kind of implement this in the legal documentation, and what sort of regulatory considerations they should also think about as well?
Yeah, Soojean, thanks for that question. Regulatory FinReg is basically a very good point to consider. I mean, all the platforms I've seen are very sophisticated when it comes to their sort of regulatory setup. I mean, in most of the cases, and I acknowledge there were some questions in this regard in the chat as well, we are talking about loan assets or receivable assets, financial assets. This actually entails lending in a lot of jurisdictions, including Germany in the EU. This is subject to banking monopoly rules, so there are a lot of, there's a lot of points to consider already when setting up the platform, that this is done in a way which is in compliance with these rules. Payment services is just another one, which also affects the structuring of the platform as such. Because I think if a lender comes in, the sort of the first question is to their lawyers normally, is this regulatory setup, is that sound? And because we want to invest and we don't want to be caught investing in something where there's a regulatory problem. So this is something which is really worthwhile considering, although I have to say that all the platforms I've seen have done a great job in that, and there's not a big problem. Now, the question is, how can you prepare for a sort of for a securitization? What else do you need to do? I mean, we have touched a lot of points already. Provision of information. There's if we do the transaction in a way that it is a securitization within the meaning of the securitization regulation, which basically means, well, if I have underlying credit assets with credit risk and I do tranching, then I fall in the ambit of the securitization regulation. I have to comply with all the rules therein. And one of the main rules is provision of information at a very granular loan-to-loan basis. Normally, that is not an issue, especially for the fintechs who have very good systems which can then deliver this information. So they are less struggling than probably more traditional players trying to do something similar. What else from the regulatory side is actually self-retention. Securitization regulation requires the seller of receivables, the originator of receivables, to retain 5% of the portfolio on its books, so that there is skin in the game. There are very different ways of how to do it. Fintech could, for example, buy the most junior tranche. There could be random selection, a randomly selected 5% portfolio which is retained. So a couple of structures available. What is quite important is that you have a person which is able to hold the retention. So there must be some ultimately some equity based in the structure as well. So this is from time to time a bit difficult. Then I think, and Daniel has mentioned this already, is the true sale aspect. We want to make sure that the assets are separated. They lend in the SPV and they're ultimately owned by the SPV. There's a little bit of the issue actually that the insolvency regimes, even the EU, are still national law. So there are different requirements in Germany and France, and as there are in Italy, and some countries also have tax issues if you are transferring assets. So it needs to be a jurisdictional analysis, which puts some limits on the scalability of the platform when it comes to securitization. That needs to be taken into account. And then I think a very important point is cash. So how is the cash processed through the structure so that it ultimately ends at the lenders? Which are the collection accounts? Can we take account security over them? Is there what we call in securitization world a commingling risk, which basically means that collections, some money which comes into the accounts of the servicer and actually should be forwarded to the investors, to the lenders, ultimately is commingled, so mixed up with other cash of the fintech and what happens in an insolvency. We talk so much about insolvency, by the way, not because we are majorly concerned with the credit risk, but it's just the way how securitization works, because we are moving away from the credit risk of the seller of the receivables. Yeah, and then there's also one point probably to consider. When we talk about securitization, we talk about private structures where there's probably one investor or two investors, sometimes also called warehouse structures. And warehouse indicates that the assets are probably not sitting there forever. So they might be taken out of the warehouse and put into a public deal at some stage. And of course, if it comes to a public deal, then you have the full scrutiny of rating agencies and the capital markets. And in many ways, these warehouse structures are a bridge into the public markets. Some fintechs have done public deals already, so it's nothing entirely new. But it gives them a very good opportunity to prepare for this additional scrutiny.
Great, thanks very much for
Soojean,
that very helpful summary, Oliver. Great. So I think just to round up our conversation, one of the things that we want to touch on, and I think it's already been mentioned throughout our conversation today, is the relationship between fintech platforms and players such as those on this panel today, kind of financial investor and private capital type investors. So due to the nature of the players and the facilities, I think a lot of these relationships are often seen more as partnership type relationships rather than kind of a true traditional lender-borrower relationship. So I suppose, Daniel, building on that, and I think you've already touched on it already as well, is how would you describe your relationship with the fintech platforms that you work with? And what do you think are sort of the key ingredients to have the perfect pairing?
Yeah, absolutely, and I think I mentioned it already. And the key word here is partnership, because in practice it truly is a partnership. Yeah, I mentioned as well. Yes, we will be the lender on record, and we will need to have the appropriate protections in place. But ultimately, we've done this business for a while, and we know that it's an ever-changing market, and the originators will have bumps along the road, and there will be a lot of changes to the team, changes to the strategy, changes to the assets, broader challenges in the macro sense as well that will need to be overcome, and these things happen along the way. And the typical sort of tenor of facilities we look at is 3 to 4 years, so that's a very long time, especially if you're someone that has been around for 2 to 3 years to start with, right? By the time we potentially finish our partnership, that would have been more than half of the life of the platform itself. So there are plenty of challenges along the way, and we don't know what they will be, but that's why I mentioned it's key to have the conversation. It's key to have that ongoing dialogue, and we end up spending so much time just inherently with the management team and the financial team, the reporting team as well within each platform, that this conversation just happens naturally. And what's important for us is to just understand what's going on, even if there are challenges, even if there are bumps. As long as we have the conversation and as long as we understand why this is happening, we're always open to a constructive conversation and making changes or tweaks to the facility if need be. Of course, we will, at the end of the day, we are also the lender, so we will have not unlimited flexibility, let me put it that way, but our primary goal is to be constructive and to be a good partner, because as I mentioned earlier, this is a question of alignment of interest at the end of the day, and the platform doing well means that we are doing well as well, and vice versa in these facilities. So yeah, from my perspective, the perfect pairing is one that makes sense from a commercial perspective, but also has that ongoing dialogue and ongoing partner style relationship.
Great. Hey, just sort of, referring to some of the things that Daniel's mentioned as well, what do you think are the greatest strengths of these types of relationships from your experience? And how do you think these relationships can benefit investors, lenders, and of course, fintech platforms as well?
Yeah. So in general, I can only re-emphasize what Daniel said before. To us, and also looking into the vehicles which we manage, partnership is certainly key, and ultimately also flowing into, let's say, a relationship on the level with our investors. There will be good times. There will be also bad times, and particularly looking into, let's say, challenging market environment. It is key to be able to align the right set of interest, and ultimately also to avoid a conflict of interest between the different parties setting up such a facility. And in general, looking into that, we are always trying to actively manage the conversation with upstream to our investors, and also downstream to our borrowers. I think this is the second vertical which also needs to be considered here, as actively managing our assets and supporting the borrowers in a challenging environment will lead to a situation where both parties, from an upstream and downstream perspective, are aligned on the way going forward. And this is how we manage the situations with our existing investors, and certainly also with the relationships which we build over time with the different banks, and other fintechs, and also investors which we very closely work with and emphasize as a market participants looking into our business in general.
Great. I mean, it sounds like for everyone, kind of active communication and certainly, a partnership is really something that's really key for these types of facilities and relationships. So I think, moving on to maybe some of the Q&A that we've received, and just to start us off, while everyone continues to provide their questions via the Q&A box. I mean, just as a start for 10, maybe, what are the key trends that everyone is seeing or that you foresee in the current space, either from a geographical perspective or a wider market perspective? I mean, Huy, from your perspective, what are you seeing and what do you see as being kind of the future trends in this space?
So we do see a very strong trend on the ABS market, or let me phrase in other words, that alternative lenders looking into the ABS / securitization market, looking into our turf. We are very actively looking into organic growth, but also inorganic growth through M&A situations, expanding our product portfolio on one side, but also on the other side, expanding into new markets. So as for the moment, the focus is for us on the German speaking regions, but we are looking into the wider European market, mainland Europe, but also have a number of discussions currently up and running on the APAC side. So based on the discussions which we had with market players so far, and also some of the investors, the markets on the APAC side seem to be also very active, and also developing very fast, and across assets besides the SME sphere, buy now, pay later, consumers, assets, etc. We do see a significant demand for capital. And we do see that investors are also increasingly looking into different markets.
Daniel, what about on your side? What are you seeing in the market, and what's your sort of crystal ball gazing forecast for upcoming trends?
Yeah, probably three things I would highlight here very quickly. One is what Huy mentioned is definitely a geographic expansion of the market and increasing sort of number of participants, both on the investor and the originator side. I would say historically this has been sort of a US Western European market, but it is increasingly a popular financing tool in a lot of other jurisdictions as well. For example, we have done a fair bit of business in Poland, and we're looking at the Baltics as investment opportunity regions as well. In terms of asset class, there is a lot of innovation in this space. I mean, it is fintech, right? At the end of the day, so there is quite a lot of innovation, leveraging off from the best parts of the finance and technology worlds, and seeing how each of these worlds can help the other, and really create something that ultimately works best for the market as a whole, and for particular types of borrowers, whether they're consumers or SMEs. So there's quite a bit of innovation, which gives rise to new asset classes or derivatives of existing asset classes, which is quite interesting. And I mean, one example would be, I know there are solar ABS transactions being done out there at the moment, and there are quite a few other completely new asset classes that have opened in the last few years. And the third thing I would mention is more on the venture capital side or equity market side of things, which have been a bit of a challenging market over the last, call it 12 to 18 months. So it is difficult for relatively early stage platforms to get seed capital, Series A, Series B capital. And that gives rise to a bit of a shift in the market, and people are looking for a more, let's say, capital light solution, whether it's an alternative way to find that skin in the game piece that Oliver mentioned earlier, or doing an alternative type of structure such as a forward flow, for example, where you're effectively selling your future originations to an investor. And yeah, these are probably the ones I would highlight.
Oliver, from your perspective, is there anything that you'd like to add that you're seeing in the market on your side?
I agree with Daniel and Huy. It's what I see is increased professionality. So the platforms are getting more and more professional, and then they are growing. Normally, they focus on like Huy has told us, he's focusing on the DACH region, and then taking it from there, collecting some experience, and then moving to other jurisdictions as well. Definitely also beyond Europe, there's some interest going into Africa. There's some talk about various Asian jurisdictions. Solar is definitely a trend at the moment, probably also becoming a topic for the public markets. Yeah, I think that's pretty much it. So it's an exciting and still growing space, I would say. It's definitely worthwhile watching.
Great. I mean, moving to some of the questions that we've had from the audience, and thank you very much to everyone for submitting these. I think the first question is probably one for you, Daniel or Huy. What is the run rate that you're looking for in originators when you're looking at kind of platforms and looking at these types of financing structures? Daniel, would you like to go first?
Yeah, happy to go first on this one. And when I hear run rate, for me, it's a question of origination volumes, but it's also a question about, as I mentioned, this always comes sort of intertwined with ultimately with performance. But from our perspective as investors, right, these type of transactions take a fair bit of time, and they're pretty complex to structure usually. So there is, I think, a relatively high bar in terms of where we want the platform to be in, call it 12 to 18 months. So what we typically start with is a commitment size of at least 25 million pounds, dollars, euros. It's almost the same thing these days. But I would say it really does depend on the weighted average life of the assets as well, because you could be originating, let's say, 5 million a month of assets that are only 2 or 3 months in tenor, but they could also be 2 or 3 years. So it really depends on how quickly the assets turn, and how quickly the outstanding book size could grow over time. So that's I would say one caveat I would make to this. And really, yeah, it all boils down to, okay, can this originator, even if they start from scratch or they start from a small back book, can they get to a 20, 25, 30 million book within 12 to 18 months? And that's usually the hurdle we try to beat. And then the other question here is on performance, I guess, and what performance needs to look like really depends on what structure we end up with and how much skin in the game there is, what the expected performance is for these types of assets, what kind of protections we think we have on the liability side, coming back to the discussion earlier. But yeah, these are probably the key quantitative metrics that we would consider here.
Huy, on your side, is there anything you'd like to add on Daniel's thoughts there as well?
Yeah, so happy to share the view more from an alternative lender perspective, as we are speaking to many investors. So I think there are 3 key points which is always on the agenda. So first of all, looking into the track record. So investors are always very keen to see what has been originated so far from a quality perspective, from a size perspective, and also looking into the distressed scenarios, defaults, recovery rates, and how ultimately the portfolio was managed in the past and will be managed going forward. I think, again, here, tech is one of the keywords. The second point is, generally speaking, the quality of underwriting, looking into the different levels of credit metrics and how these are actually integrated into a deal execution / underwriting process. And I think the third point is what Daniel also mentioned before, the ability to originate a sufficient level of volume is certainly also one aspect which is always highlighted by the investors.
Great, thank you very much, both. Another question that we've had from the audience is, we've been talking obviously quite a lot about assets, receivables, and financing them. Oliver, would you be able to give us a bit of color about what we mean when we talk about assets and receivables, and kind of, I guess, the range of receivables that we've seen financed by these facilities? I think that's one of the questions that's been raised.
Sure. So, Gina, it's the beauty about receivables, by the way, is we call them self-liquidating assets. So you basically buy them, and then you normally, at least if the borrower or the debtor pays, you just wait for the collection to come in. You don't have to sell them in the market. You don't have to find a buyer. You don't have to worry about market for receivables and all that kind of stuff in the normal scenario. And this is where securitization actually works. You're looking for something which is a self-liquidating asset. And then the only other requirement basically is that it is transferable. Some assets are a bit sticky. They cannot simply be assigned in an insolvency-proof way. When it comes to leases, for example, this can be quite a complex scenario. But generally speaking, if there is a cash flow, and if this is assignable, so transferable to an SPV, then you potentially have a deal. That's the starting point. It also means that, yes, indeed, what we're talking today is a bit about neobanks and fintechs originating whatever kind of receivables, normally in the loan space, but we've also seen others. And it not necessarily applies to, for example, to payment service providers where they don't actually have self-liquidating assets. You have to look for another financing technique there.
Yeah, and as Oliver, as we all know, certainly we've seen a lot of different types of techniques used, and all of this is incredibly flexible and can be used for a lot of different platforms, not just neobanks and lending type businesses as well, as you touched on. Great. Yeah. I think we've got time for one final question. So I think maybe this is maybe one for you, Daniel and Huy. I suppose just to very briefly touch on, we've obviously talked about asset-backed lending, asset-backed facilities. What do you think are the key differences when you look at asset-backed lending for fintechs versus when you're looking at it for a traditional sort of bank or a traditional kind of originator out there in the market? If you could maybe give us a couple of key differences that you look at and that you experience. Huy, shall we start with you?
Yeah, so happy to take this one. I think just to clarify here, ultimately we are not in investing into, let's say, specific platforms. So again, I can share my view on, let's say, more from an alternative lender perspective here. And as we also manage different kind of vehicles, as mentioned before, an ABS vehicle, but we also managing a private debt fund. And maybe starting by this comparison and highlighting the differences is I think the first point is certainly the different structure which we use. So as Oliver mentioned before, looking into the ABS side, there is a very clear focus on risk integration aspect. On the other side, looking into a very traditional RAVE debt fund structure, there's a more flexibility on how to structure an investment mandate. And then we are coming back to what Daniel mentioned before with respect to, let's say, a traditional set of concentration limits, portfolio parameters, performance triggers, which are I would say market standard on the ABS side. So looking into the main differences, I think the investment mandate, or how to form and to describe an investment mandate, is more flexible on the debt fund side. However, looking into the nature of the assets which we are originating, which are let's say quite small assets, and ultimately from a portfolio perspective, a significant granular and highly diversified portfolio, there are a number of advantages which need to be considered to set up a more kind of securitization type of vehicle to have the, let's say, the platform to build a more diversified and granular portfolio.
Great. And Daniel, on your side as well, very briefly, what do you see as being the key differences from your perspective?
Yeah, it's. I would start probably with the profile of the whole company in the creditworthiness, right? If you're looking at a corporate or maybe a bank, then yeah, inherently they will have a better credit profile than a fintech originator in the grand scheme of things. So I would say the point that I made earlier about making sure that the entity is around to continue originating receivables and to service existing receivables is much more important for a younger and more dynamic platform than for an established corporate originator. I would say as well, it's for a corporate or a bank. We would expect them to, be up to date for sure with all legal and regulatory frameworks and be compliant with all of them. While with fintech originators, while they do their best and they have typically teams that look after that, we will do a more thorough check to make sure that these boxes are ticked and all legal and regulatory frameworks that are relevant are actually, well covered, and there are no sort of hidden risks or lapses. And I would say a fintech originator could have, bespoke or third-party technology in the way that they underwrite and they service the receivables, and that's usually a good thing and allows them to do so in scale and leverage off technology in order to do these things better. But we also do spend a lot of time to make sure that technology actually works in practice, and it's something that is, I would say, yeah, something we do spend a fair bit of time on to make sure that it's at the end of the day a technology that does work and does add value to all these processes.
Great. I think that's all we have time for today, but I did want to take a moment to thank you to everyone to joining us today on this session. And in particular, thank you very much to all of our panelists who've taken the time to speak to us today. I encourage everyone to please do check out our agenda for the rest of our festival happening over the next couple of days. And please do join sessions that might be of interest. Thank you very much, everyone, for joining.